Kitco News special coverage of the PDAC convention is brought to you by Gold Mining and Uranium Energy Corp.
Has the S&P 500 officially entered a bear market? Well, that is a debate that investors and economists are having right now. And joining us to talk about market action is John Feneck. He is the founder and CEO of Feneck Consulting, and he is an expert on all things mining stocks. Welcome back to the show.
Thank you, David.
Don't chuckle, you're an expert. That's what you are. Own up to it. John, great talk we had last time a couple months ago. You had correctly called for a bear market.
Yes.
Well, not so much a bear market, but a correction in the markets. Let's be technical there. So can you define, first of all, the difference between a correction and a sustained bear market?
Yeah, sure. And thanks for having me back. It's always a pleasure. A correction would be, something in the order of, in my view, maybe 8 to 15%. We saw something like that in the fall of 18, where we had S&P actually was down 19.9 December 24th of 18. It didn't feel like it at the time, but it bounced very sharply off of that low. This time, as we sit here right now, the S&P is down an even 20%. 20%, when you get to that number and higher, is the beginning of a bear market, in my view. So the NASDAQ is down 30 as we sit here. So these are year-to-date numbers. This is less than 6 months. This is painful for a lot of investors. When we last sat down in March, when you look at household names like Walmart, Target, Netflix, these charts were intact. They're not intact anymore.
Mm-hmm. John, let's revisit your call from a few months ago. Sure. Walk us through your rationale for calling for a correction back then.
So I've spent most of my career, as I've mentioned on your show before, in the financial markets working for larger institutions. So I think I have a good idea of what the mindset of a portfolio manager is. I've only done it myself for 6+ years, but I've worked for many of them for my 30-year career. And last year, it seemed like things were really getting stretched. November, December just felt to me like people were trying to make bonuses happen. Right. And the broad market kept going up with no real reasoning behind it. And January 5th of this year was significant for me, and we went heavily short a number of things on January 5th when the Fed turned very hawkish. And that hawkishness has not backed down whatsoever in our view. We've seen 75 basis points through the March and May Fed meetings. We'll probably see 50 more tomorrow, June 15th, and that would be 125 basis points in less than 6 months. So the Fed is sticking to their knitting. They're saying we have to raise rates, and they're doing it. So until that changes, there's going to be a lot of angst in the market, and that was our thesis, was the Fed's going to hold true to their talk.
Okay. I think you're actually more or less a contrarian in the gold space, in the sense that you believe that the Fed will hold true to the talk. A lot of people I've talked to think that the Fed is just full of bluster right now, that it's really not possible to raise rates to the extent in which they're signaling. How would you respond to that counter argument?
Sure, I would agree with that. But I would also say that when the Fed cut on a Sunday by 100 basis points in 2020, that was ridiculous. It was over the top. And it fueled this buying that to me was fluff in a lot of sectors. It pushed tech way up. It pushed travel and leisure way up. These are sectors that are very vulnerable, and we're seeing that play out now. So it's sort of like when people are saying, well, how are these stocks down so much? How are they up so much? I mean, you have to understand that things really were floating there for a while on air.
It seems to me that the market isn't so much adjusting for rate hikes anymore, because that has already been aptly telegraphed, shall we say. And maybe now the markets are adjusting for an even worse economic condition. Some might even say recession.
Yes.
Would you agree with that?
Yes. We're seeing, if we see another quarterly GDP read in below zero, which we just saw a few weeks ago, we think that is, a good indication that we'll see a recession by this time next year. And I think that when you look at CPI raging higher, as we've talked about on previous interviews, we've been in the camp that CPI will remain high, and it has. And it just hit another 40-year high June 10th.
Janet Yellen said that there's no signs of a recession. She was responding to a Cardi B tweet in which Cardi B, the pop singer, was worried about a recession, and I think Yellen responded during an interview on stage at an event, and she said, "No, I don't see any signs of a recession."
I don't know what she's looking at, but when you look at the average investor / consumer out there, they're feeling a lot of pain. I just got done with a vacation, it's $350 a night at a hotel. It's a $40 resort fee. It's this much to park in the middle of nowhere. It's like the hotel business to me. I've stayed in over 3,000 hotels in my career. I don't get it at this point. Hilton and Hyatt and some of these CEOs recently, just last week, were saying that they had really good quarters and they're going to see continued growth and they're going to kill it. I disagree. I think that eventually clients will put their foot down and say, I just can't afford this. I make 50 grand a year and I have a family of 4 and I can't do it. So the staycation is starting to dwindle even, right? It's like people really can't afford to do as much as they used to do because of what's happening with inflation. And I think that people are going to start charging away on their credit cards, and it's going to cause a lot of personal bankruptcies.
Look at this chart. High yield credit default swaps. Now, in 2020, we saw a massive peak and spike, but that was because of COVID. And notice how dramatic the rise was, and it came back down. Here we're seeing a more gradual rise, which in many ways is more worrying.
Yes.
Yeah. How are you interpreting this chart?
I don't follow that chart per se, but I would say that in terms of the word gradual, when you see the price action we saw yesterday, June 13th, as well as certain days this year, I don't think there's anything gradual about this correction. It's going to be swift on the equity side. I don't know so much about the bond side, but to your point, like if you look at the 20-year ETF, TLT, it's been in decline for months. It's like, we have a situation on our hands where the bond market worked for 40 plus years. That's not working now, right? Crypto worked when we first met a couple of years ago. That just Bitcoin hit a 1.5-year low yesterday. There's less places people can put their money.
Well, the credit default swap, it signals a rising risk of default amongst corporations for their fixed income products. And so that to me shows that investors are worried about companies not being able to pay back their debt obligations, which usually only happens during a very severe recession. Is that right?
Yes, and that, in my view, would be anyone who would go bankrupt here wasn't paying attention for many years previously, right? It's like we had this low interest rate environments. To say now I just thought that interest rates were going to remain low for the rest of our lives is foolish. So I think anyone who went over their skis, meaning a company, and went into heavy debt and are surprised by this, I don't see where they would be surprised.
So John, investors want to know from you and other experts how much further this bear market could go. You mentioned to me just now that you expect a recession to happen next year.
Yeah.
Well, if the economic conditions will only get worse from here, what does that mean for the markets?
Sure. So I have zero money invested in the broad market, so I am short about 11 or 12% in the broad market right now. And when I look at our sector, meaning gold, silver, and industrial metals, I think you're already seeing a bid in certain commodities, but you haven't seen a bid in something like silver. Silver is trying to figure itself out. It's trading like an industrial on certain days, trading like a precious on other days. But when I hear from clients about why isn't gold above 2,000, given all this, talk about CPI and such, I remind them that we haven't broken support. The GLD chart, just using that as a proxy, has made a series of higher lows for months. So gold, even here at the 1820 level, isn't that worrisome to me. It's worrisome that like silver sort of is just oscillating, and it could go either way, right? And if it goes down from here, you could see something in the 18 to 19 an ounce range from 21 and change right now, which would be pretty bad for a lot of the silver miners.
Yeah, I was just looking at, just off the top of my head, First Majestic Silver, their all-in sustaining cost is between $16.70 something and $18 an ounce. That's for their 2022 guidance. And so if you're talking about $19 an ounce of silver, that's a very short, that's a very narrow margin for some of these miners.
Exactly. If you're a producer like First Majestic is. I think that it will start to, if that happens, you're going to see a lot of companies say, you know what, I'm just going to put this mine on care and maintenance. Why would I drill here? If I'm going to break even, right? And then you'll see a supply demand imbalance as a result of that eventually.
Well, so you're saying that silver is going to react poorly to this recession. When the past two recessions, three as a matter of fact, 2020, 2008, and 2001, very short recession, 2001, silver went down in all these three periods. Are you expecting it to perform similarly in the next recession?
I think we're seeing that gradual move down right now. And if you look at the fall of 2018 for our sector, right, GDXJ, just using that as a proxy,
Right.
in December of 2018, it started to take off. And by summer of in December of 2008, it started to take off. And by summer of 2009, it was up over 180%, I believe, in 6 months or so. So that move would be welcomed by investors right now. But what I tell people is we watch the GDX and J moves very closely. May 18th, we started to see GDX and J start acting as hedges, meaning broad market down or flat, GDX and J flat or up. That action was really played out on June 10th again. If you looked at what happened with the CPI read, look at what happened with the broad market. Down huge, GDX and J both up substantially. That's what we need to see, is that kind of bifurcation with GDX and J acting as a hedge alongside of GLD and silver.
Okay. We're going to come back to GDX and GDXJ. Sure. Silver. Why is it that silver moves down during a recession? When you think about it, its monetary metal properties or its safe haven properties should actually propel it to go up, if not stay flat, like gold did this year. I mean, gold wasn't a fantastic asset this year to date in terms of its absolute performance, but its relative performance compared to stocks, cryptos, has been excellent.
Yeah.
And so you would expect silver as an asset that follows gold to also do well during a recession,
Right.
Yet it doesn't seem to do that. Why is that?
That is the $64,000 question. It is the most perplexing thing for investors in this space right now is why hasn't silver performed? It's for us, you just have to follow price, and the price is going down. So we're not loading up on silver miners until we see that 2350 level breach to the upside on some good volume, and we head back towards 25, which would be kind of now medium-term resistance.
Is it because of silver's industrial properties that really drag it down? So the notion that silver is more of a monetary metal, that's not really true then, is it?
I see it trade like an industrial on many days and trade like a precious on days like June 10th. It's very frustrating. I don't know how to figure it out. So we don't go over our skis and put a lot of money there until we can see a clear direction.
All right, moving on to the GDX. But before we do that, which assets do you think will have the most downside going into 2023? Stocks, so just the broad markets, S&P 500, tech stocks, I'm going to make that a separate category, gold, silver, or the base metals?
Oh, definitely like tech stocks, anything with beta, to it. That would be the QQQ, the NASDAQ, the IWM, the Russell, all of those kind of investments. The momentum game is over. You can't play that game at this point in the cycle. People try to bottom fish things, and they keep catching a falling knife.
Do you have any thoughts on crude oil?
I mean, at 120 or wherever it was, the last I looked, June 10th, it's too high, in my view. I think when you get a resolution, if you get a resolution in Russia, Ukraine, that price would drop significantly. And so you see some elevated levels because of what's happening overseas.
Do you think that should oil pull back, let's assume you're right, pull back from 120 down to $190, $80, whatever the case may be, do you think that would bring down inflation numbers?
Yeah, it just wouldn't happen right away. I think that inflation is going to be elevated here for quite some time. And everyone's gotten that wrong, right? I mean, whether it's Yellen or Powell, everyone at the Fed has gotten inflation incorrect. And at least they admitted that in November, but by then it was too late.
It's a very interesting market because on the one hand, gold needs inflation, amongst other things, to do well. And some are saying that inflation can't be sustained if oil drops. So maybe the gold market needs a higher oil price. Who knows? Which is also ironic because the gold miners need a lower oil price to bring down their costs.
The producers, absolutely. Yes. Yeah. That will eat into earnings eventually. But we'll see when they come out with their next reports here in a few weeks, actually how much that is impacting their bottom line.
Okay, let's talk about the GDX then,
Sure.
The miners. Now, do you think that producers are usually a leading indicator for the gold price?
You saw Newmont since December 15th until spring of 2022 really lead the pack, right? NEM led the entire mining complex into a rally that, as you sit here right now, looks like a head fake, right? big money came into that stock because of the dividend.
Yeah.
And AUY, Yamana was another one that was a darling. There were some names like that you could pull up charts on and say, wow, that looks pretty good. The cool thing about it is those charts aren't broken. There are a lot of junior stocks that are broken right now. They've broken support. In fact, they've even broken March of 2020 lows, which to me is insane. You know, it's like that's why we spent a lot of money in the last 6 months investing in Explorcos, because we think that the really small names that no one's ever heard of before, if they get a good drill result, if they merge, you know, you saw the Gold Standard Ventures deal yesterday. There's going to be a lot of different companies you can invest in to make a lot of money, but you have to use a rifle approach.
Okay. All right. Let's pick a few names for the audience, miners that you like right now.
Sure. So along that theme of smaller names, you know, I've mentioned on your show once before, Golden Minerals, AUMN. It's a silver and gold play. It's producing right now a small amount of gold, but it will make a decision on restarting a larger mine next month in July, and that mine is called Velardania. So that's been on our radar for about 2 years now, because the restart was supposed to happen last year, but because silver price was sort of languishing, they decided to hold off until this year. But I really feel that would be accretive to the company, and you know, here at 36 cents, it looks really good. The support seems to be in that 33 to 34 range, so some nice upside in that name. Fundamental research just wrote it up at 87 cents, and all analysts are at 90 to $1.10. I mentioned U.S. gold in your program around $7, and I was dead wrong. U.S. gold took a phone call from a hedge fund shortly after that wanted to buy into the stock, and the next day they did a $5 million deal with them. So you can't fault them for that, because, as you know, the junior market is really tough right now for raising capital. So they took the money, it diluted the stock a bit, but when you look at the share count, it's still under 10 million shares outstanding. So when you look at the junior market, how many companies have you interviewed that have, you know, 300, 400 million shares out? So I think there's still a lot of upside there. They're on the NASDAQ. They have a new chairman in Luke Norman, who has a lot of mining experience, former CEO, and they want to get a Toronto-based listing by probably Q3, Q4. So that will bring in a lot of new investors, in my opinion. We've talked about Palladium in the past. You know, I mentioned Palladium on your show a couple times, and I think the Palladium price is really getting bombed out here. If you look at the chart over the last, you know, year-to-date chart even, it looks like an inverted V. You know, you've had a huge run up on the Russian news, huge run down. I think Palladium was starting to find a low here soon, and in that regard, we like a couple of Palladium names: Canadian Palladium, DCNNF. I think there's going to be some news there. They've telegraphed publicly for a while now. It's just probably been delayed a bit, like everything else. And also Clean Air Metals, which is CLRMF. It just broke 14 cents here this morning. I just don't understand how you have a guy in Jim Gallagher who created a lot of value for shareholders with PALDF and sold it for $1 billion just two and a half years ago. He is the chairman of this stock, came out of retirement. So I think Clean Air Metals looks really interesting at 14.
All right, John. I appreciate your insights. Thank you for sharing your picks with us, and we'll speak again soon.
Thanks, David.
All right, good seeing you in Toronto. And thank you for watching Kitco News at the PDAC. We'll have more for you. Stay tuned.
Kitco News special coverage of the PDAC convention is brought to you by Gold Mining and Uranium Energy Corp.